Welcome to the Jay Martin Show, where we dissect the greatest minds in geopolitics and finance. Most investors today are obsessing over whether or not the Fed is going to cut rates in the coming quarters or by how much they're going to cut rates in the near future. That may be the exact wrong question to ask. My guest today explains why the American economy might be far more desensitized to rate cuts than people understand or are willing to acknowledge because of how American debt is structured. We get into that and much more in today's episode with Lyn Alden. This is the Jay Martin Show. Enjoy.
This is Jay Martin.
All right, here I am with Lyn Alden. Lyn, it's great to have you back on the show.
Happy to be back. Thanks for having me again.
So there's a handful of directions I want to go today, but let's start with this. I feel like everybody is obsessing over whether or not Powell will cut rates in September and the subsequent quarters, and how much will he cut rates and all of this. And maybe that's making an assumption about what will happen when rates get cut. In one of your recent pieces, you made a pretty compelling argument as to why the impact of a rate cut would be much number than people assume because of how much of America's debt is structured and how desensitized Americans are to rate changes. Could we use that as a jump-off point today? Explain that argument for me.
Sure. And so, I expect that we're probably going to see at least 25 basis points cut in September. They've rather firmly signaled that they're going to at least begin a rate cutting cycle. It's unclear how fast they're going to go. That's going to depend partially on what happens in the next couple quarters, economy-wise speaking. The argument that I made in that recent newsletter is that much like how the U.S. was rather desensitized to rising rates, it's not immune to rising rates, but it's rather desensitized to them, especially compared to many other economies, that I think would also be likely desensitized on the way down, which is not necessarily a good thing. And this is largely for a few reasons, primarily that the United States, the way that our housing financing works, consumers tend to lock in longer term mortgages compared to most other countries. It varies by country to country, but in general, most countries have less of a long-term fixed rate. And so when their central bank raises interest rates, it generally over a handful of years starts really trickling through the consumer base. Whereas in the United States, it's been really spotty because if you don't own a home, if you don't have a lot of assets, then unfortunately you are kind of locked out of affordable home buying, right? That's a tangible issue with raising rates. But the majority of spending actually kind of comes from the top half of the population. And a lot of them are actually doing quite well, despite the fact that interest rates went up so much. And then even looking at the corporate sector, if you compare, say, the United States to Europe, corporations in the U.S. get more of their debt financing from the bond market and tend to lock in these longer rates, whereas European companies, of course, they are active in the bond market, but they have a higher ratio of bank lending. And in the United States, it's really the smaller businesses that are reliant on bank lending. So that means shorter term loans, more rate sensitive. And so when they cut rates, what makes this cycle somewhat different is that we're less likely to get a lower low in interest rates. So over the past 40 years, one of the most powerful aspects of cutting rates, especially by a meaningful degree, is we get a lower low, both generally in short-term and long-term rates. And then that allows a lot of homeowners to refinance their mortgages, which is kind of a free lunch. If interest rates go down enough, they refinance and they have lower monthly payments going forward. So they get more nominal spending power. And that's been a cycle that's repeated over and over again. There was a huge refinancing cycle, in 2020 and 2021. And if they cut rates by 50 basis points, 100 basis points, even 200 or 300 basis points, it's not necessarily a lower low in interest rates. This was the first higher high in like 4 decades for interest rates. And I think the thing we have to see next is if we do indeed get like a higher low, there's kind of marginal refinancing. So people that were unlucky enough to, take out a mortgage in 2022 or 2023, which was actually pretty low volumes, they'll be in a position to refinance. And, there'll be some stimulus from that. And some of the more troubled areas, maybe certain marginal commercial real estate or certain small businesses that are kind of struggling, they'll get some benefit out of those lower rates. But the big chunks of where debt is, a lot of that's fixed at lower rates than they are now. So I think it'll be less stimulative than many people think.
So it's kind of a tale of two populations. You discussed, individuals and the more affluent percent that are homeowners and probably locked in a low rate 30-year fixed in 2020, 2021. And for them, in an indirect way, higher rates are almost stimulatory because as rates go up, their mortgage payment doesn't get touched, but maybe they keep their savings in money market funds, which are now paying them more. And so their income's gone up, their costs have stayed fixed. And same when you mentioned smaller corporations having to lean on short-term debt, they're impacted by increased rates, but larger companies, and this example you used in your letter, say a cashed up big cap tech company has locked in their debt at a low rate, fixed term, long duration, and maybe they keep their cash in, cash equivalents, money markets. They're now getting paid more on that. And simultaneously, who are they? These big companies, specifically big tech selling products to, it's that same affluent class who now has a higher income, buying more products, stimulating the big cap tech companies. And this cycle is actually stimulatory for the top half of the market or top percent of the market. Yes?
Exactly. Yeah, and it applies, like you said, for both individuals and corporations. So if you're a wealthier individual, you either don't have a mortgage or you locked in a fixed rate mortgage. If you didn't plan to move, you kind of just ignore the higher rates, and then if anything, your money markets and your T-bills pay more income, which is spendable. So we've seen, for example, while some areas of the economy have slowed down, the travel and hospitality industry has been great, and a lot of that is fueled by say upper middle class older spenders that have both time and money to travel. And really rate cuts are neutral to stimulatory for many of them, especially because stocks have also done well, and the wealth effect is positive. And then you apply the same logic to corporations. The kind of the more profitable, larger, more successful the company is, the more likely they've been able to lock in low fixed rate debt, which is kind of a great investment. They're basically shorting fiat currency for 10, 20 years at similar rates that the government can in many cases.
Right.
And then their cash equivalents are held in T-bills, money markets. And so some of them are making like $1 billion in interest per year on their cash holding. Even some energy companies did that, like ExxonMobil, for example. It's not just tech; it's anything that's kind of got a decent balance sheet, is profitable, and has done that arbitrage. And so that there's kind of limited effect, and then especially that's combined with the fact that every time they raise interest rates, the public, the deficit's blowing out, interest expenses increasing, and deficits tend to be stimulatory. At least in the nominal sense. The risk, of course, is that you get inflation generally with that as well. So it's a stimulatory but inflationary effect. And when the Fed raises rates trying to slow down the economy, they're also increasing the deficits, which pours out to the receivers of those interests. And so we kind of have this K-shaped economy situation where there's data point after data point showing that the bottom half of the population is really under pressure right now. Inflation has been a really big pressure on them. They're locked out of the home buying market. Sales at kind of lower income retailers are keep coming in poorly. Whereas on that upper half, and especially the top third or the top quartile, they've generally still been holding up pretty well. And it's just kind of the circular loop. And it just shows the somewhat ineffectiveness of the current policy regime.
So then let me ask you, if you're the Fed and you look at it September and you're thinking about cutting rates, what you're telling the public is that you're looking at the economic data and it's time to ease a little bit. But what's really occurring if such a large percent of the wealthy population is actually doing just fine under these conditions? Who's really under pressure? Obviously, a lot of people are, but also the Fed is, because they have to make these interest payments. And so could the true motivation for a rate cut be that the Fed needs to cut their own interest rate payments more so than they're worried about the state of the real economy?
Well, so the Fed has a long runway for where their interest payments would become a problem. There are some countries where the way the rules work is that the government has to compensate the central bank for running losses, which makes for really bad headlines, really bad optics. It's like, hey, we did all this QE, we literally somehow lost money from printing money, and we need taxpayers to fill that gap. That's a terrible headline. The way it works in the United States is they just defer the losses until literally years down the line when they return to profitability, they just pay that back. They kind of dig themselves out of the hole. It's basically a bank that can go into negative equity and no one can do a bank run on it because the deposits are banks, and they're kind of locked into that monopoly. So they don't really have any sort of immediate need to cut. Now, you could argue that the United States, however, needs lower interest rates, that basically that the central bank looks at the fiscal deficit side and wants to be accommodative. That's certainly a possibility. That's generally what happens when you get well over 100% debt to GDP. You usually get some degree of financial repression, either subtly or overtly. So that's certainly a factor. And then there's just the fact that high rates are less effective when the government is so indebted for reasons I outlined, which is that when fiscal deficits are bigger than the amount of bank lending that happens in a given year, or even bigger than the sum of new bank loans and new corporate bond issuance, rate hikes become less effective at slowing things down because you're exacerbating the deficits pouring money into the economy. And then the final factor is that when you could back up a second and say, should the central bank even set interest rates? I would argue no. Like, I don't really agree with the philosophy of central banks setting the price of money because in every other context, price controls are bad. And I don't see why money would be different. I think there's a lot of evidence showing that it's bad. But in the current laws for how they operate, they have this kind of mandate between inflation and unemployment. And when they see the official way that they measure inflation falling down to around 3%, which is still above their target, but it's not extremely above their target like it was before. And then they see unemployment go from 3.4 to 4.3%, which is already at the high end of their projections for what they thought it would look like by the end of next year. Like, so it already kind of reached their quote unquote target, or where they expect it to be. They certainly can. I can see why now they're balancing between these two mandates. They spent a while kind of only during the lockdowns and everything, they were fully focused on the unemployment side. They didn't care about inflation. And then when inflation took off, they were late to respond to it. But when they responded to it, they kind of were like just fully on the inflation camp. And now they're kind of back toward balancing both of those mandates. So I think that gradual cuts make some sense if you're following that algorithm of trying to balance those two numbers, which again, philosophically, you could say it's not even a good mandate to be following, but that's the mandate they have in front of them.
Right. And this situation that you just described where the fiscal deficits outweigh corporate credit issuance, if I understood that correctly, that's the concept essentially of fiscal dominance, correct?
Yeah, the fiscal dominance has a couple different ways of defining it, but yeah, it's basically when the fiscal side is so much more impactful than the monetary side, and then can even constrain the monetary authority from doing what they want to do. And it could take a couple different forms. It could be like what's happening now, which is that they make rate hikes less effective, because if you when Volcker raised rates, 40 plus years ago, he did it in the context where public debt to GDP was like 30%. And the money supply growth is mostly coming from the highest ever level of bank lending. And that was because
Okay.
baby boomers were entering their home buying years. So peak credit formation, plus, of course, you have all the issues around, oil shortages, going off the gold peg, all the supply side issues. But the demand side was like, where was money coming from? It was mainly coming from bank lending. And so when he raised rates, he slowed down the bank lending, and he did blow out the deficit too, but he blew it out from 30% of GDP. So the downward pressure his rate hikes put on the bank lending was greater than the upward pressure it put on deficits. Whereas when you're in Powell's situation and you're raising rates against like 125% debt to GDP, he did slow down bank lending, but bank lending was already kind of moderate. That wasn't the source of excess money creation. So he slowed down something that was already moderate, but then he completely blew out the deficit by, ironically, an even larger number than the bank lending. And so we're kind of stuck with inflation, years after the the kind of the core stimulus and the lockdowns and all that, we're still at above target inflation because some of it's sticky, and it just becomes less effective. And then if you look at the New York Fed's annual report, they project that by the end of 2025, they're probably going to go back to balance sheet increases. And that's not necessarily to be stimulative on purpose, but it's to maintain what they would consider ample bank reserves in line with nominal GDP. So like it would kind of go up at the same rate as GDP if they're not trying to be stimulative or restrictive. But that basically means they intend to go back to structural deficit monetization. And so basically a central bank can lose control of its balance sheet size if the government's just pouring out too many bonds, and one of their kind of shadow mandates is financial stability. So if the treasury market ever goes illiquid, they kind of have to step in. That's what we saw when the UK gilt market blew up in 2022. And I think we'll see more of that happen in various developed countries where a central bank might have to do QE even when inflation's above target, and then you get kind of like emerging market like characteristics, at least around the margins.
So maybe my last question on rates for you then, Lyn. Jim Grant outlines rates inside of like 40-year cycles and says if you look 80 years to the past, you'll see that rates pretty much went up from like 1940 to 1980, right? Rates have pretty much gone down from 1980 to 2020. Ups and downs along the way, but the secular curve is very apparent in hindsight. You said, we're probably going to see rate cuts, but we're going to see higher lows and I suppose, higher lows on the way down, right? We're not going to go back to zero interest rates likely anyways. Do you align with Jim's sort of timeline there, or is it possible to even speculate that sort of duration when it comes to rates, or what's your take?
Well, so there's a challenge with sample size. So that was like one big, 80-year cycle. If you look at the prior 80 years, there wasn't that big cycle because that was a whole different monetary environment. That was like more of a gold standard. Even some of that 80-year period would have been free banking. So that was a different environment. So it's kind of like this one snapshot in time. Even, there's like data sets that go back like thousands of years and look at like, interest rates throughout, like, say, Europe going back, and like Mesopotamia going back very long time. The interest rates that we got to in the middle of the 20th century were like the highest ever. And that's also because this is the only time where the entire world was on fiat currency. This kind of 50 plus year period is actually kind of unusual in monetary history. So I think it's kind of difficult to project it going forward. The way that I would kind of frame it is that, in the 1970s, they defaulted on the gold redemption, but they still had a lot of capital built up, especially after Volcker raised rates so much. And they've kind of spent 40 years drawing down from that like really powerful starting point. And the way that they got out of every recession was keep inflating it, keep reinflating it. So every time we would have a recession, they cut rates. They encourage more credit growth to keep happening, both on the private side and then the public side. And then when it kind of fully, when you hit zero rates and there's really not much more to do, the private side finally starts to blow up. That's what we saw in 2008. So most metrics were like, debt compared to base money, for example, or all those types of metrics were extremely out of line based on historical norms. And so then they turned to money printing. They radically increased the monetary base, and they kind of indirectly pivot some of that private debt toward the public sector. So they bail out the banks. When the next recession comes and we get the lockdowns, and then you kind of bail out individuals, bail out small businesses, bail out big businesses. Again, you kind of rotated some of that private debt to the public debt. And really, when they kind of get it this far, there's not many more places to kick the can. The can's now kind of firmly with the currency. That's where the can gets kicked. It gets kicked into currency devaluation, financial repression. And so, my base case would be interest rates are kind of choppy and sideways for a while. I wouldn't be surprised if we just ping pong between 2 and 6% or somewhere in there. Obviously, it's going to depend on what happens, but there's a certain point where, if you have very high public debt and you have inflation coming from fiscal deficits, raising rates stops being effective because you literally just increase the deficits even more. And so it just kind of it risk becoming a tailspin. So I think that the future in general just looks very different because we've never really gotten to a place where fiat currency, kind of exhausted a lot of its options. And the whole world's on this fiat standard. This is kind of a new situation. So I wouldn't sit there and say, well, look, okay, it took 40 years of rising rates and 40 years of falling rates, and we're going to get 40 years of rising rates. I don't think there's a pattern that close, other than to say that clearly the 40-year pattern of falling rates is behind us now.
Okay. Okay. I appreciate that. And yeah, great context, by the way. I want to ask you a question about equity rotation, a concept that I've heard both you and Luke Groman and several others discuss recently. And if you look at the equity market today, there's crazy consolidation among the Mag 7 and maybe even the Mag 5 at this point. But eventually all the buyers will buy and all that will be left are sellers. I mean, eventually every market gets to that point. Were you surprised this week when NVIDIA's earnings came out and they beat expectations, but the stock responded by falling 8%? And do you think that's reflective of a rotation away from something towards something else? And if so, what would that be? And what's your take?
Well, so I think that it's priced so that even high expectations aren't high enough. That's how a lot of these things work. And so when selling happens on good news, that just kind of shows exhaustion in the market. Right now there's a lot of global capital stuffed into U.S. equity markets. It's kind of been like the only investable spot for like 10, 15 years. And this historically does go through some cycles. Again, there's not a huge sample size because the modern era of finance is only so long. But when you look at, for example, developed versus emerging markets, they tend to go with these big dollar cycles. And that also kind of aligns with the commodity capex cycles, which is where you get periods of disinflation or reinflation. And so I do think that there's a meaningful risk going forward that global capital, or at least around the margins, starts pulling out of U.S. equities and starts going back elsewhere where things are cheaper. And you can start kind of a flywheel. So, generally speaking, the way that emerging markets work, and China and India are a little bit different, but many emerging markets, they have a lot of dollar-denominated debt. And it's mostly not owed to the U.S. It's mostly owed to other countries. It's owed to European lenders. It's owed to Japanese lenders. It's owed to Chinese lenders. It's all this, but it's denominated in dollars. And when the dollar strengthens because of a hawkish Fed or other multiple variables go into that. When the dollar strengthens, it squeezes all those emerging markets because their liabilities are hardening relative to their cash flows and their asset prices, and that's just, it's a very poor liquidity environment for them. And then that kind of starts a flywheel because then capital doesn't want to be there where the whole place is doing badly. So they take money out and then they put it into the U.S., which further strengthens the dollar and further exacerbates that issue. But it eventually gets to a point where it kind of breaks all the countries that are not strong enough to, they don't have enough reserves. They have too much dollar-denominated debt. Other ones hold in there. And so eventually that kind of exhausts itself. The U.S. economy itself starts to slow down. The U.S. does some sort of dovish pivot, and then you can actually have that flywheel go in the other direction, where finally the dollar's weakening a little bit, which gives them signs of life. Their liabilities are softening relative to their cash flows, and then investors can see that and say, look, there's signs of life. Maybe I want to take the marginal dollar out of Costco that's trading at 55 times earnings, and where I wanted to be there because it's super safe. Maybe I can take the marginal dollar out and put it into Southeast Asia or into Latin America. And then that, takes a little pressure off the dollar, strengthens those markets, and that furthers the flywheel. So capital flows become the fundamentals, which then encourage more capital flows. And the risk here is that it's very easy to be early. There's been a lot of people calling for asset rotations for a very long time. And myself included at times, because there's certain catalysts where there's a window that's open for it, and then you either see if it's going to happen, and if it doesn't, you move on to it not happening, right? So the last time there was a serious catalyst was 2019. That was the last time the Fed began a rate cutting cycle. That was before the pandemic. The U.S. economy was slowing. They started cutting interest rates. By the end of the year, they went back to balance sheet increases. And this started to look like a potential rotation because there was so much capital stuffed into the U.S. and they were finally turning dovish. But then, of course, that all got derailed by the pandemic. because many emerging markets did not hold up as well as the United States and other countries did. And so this is kind of the first serious catalyst in 5 years here in 2024. And that doesn't mean that it's guaranteed to happen this time. There's certainly things that could derail it. But this is like a very narrow window where there's a meaningful chance that a rotation could occur. So the last one was 2019. The one before that would have been the great financial crisis cutting cycle, but that was at the end of an emerging market cycle. Capital's already in emerging markets at that time. The dollar was weak going into the global financial crisis. And then the one before that was the post-dot-com cutting cycle, and that was indeed the last time there was a rotation from overvalued, overinvested U.S. equities into emerging markets. So not a huge sample size, but in this kind of past 25-year period, this is a pretty significant window, I would say.
So I know my audience is going to be curious now because post.com was a great gold market. Post 2008 was a great gold market. You mentioned emerging markets as one of those potential locations capital could rotate towards. I have to ask, what about commodities? What about gold? Do you see them through a similar lens in this regard?
Yeah, they all tend to rotate together at different speeds. So generally, if you have decades where emerging markets doing well, it's generally because the dollar's weakened. That's generally really good for gold, and it's generally really good for commodities because they're globally largely priced in dollars. Now that's changing a little bit around the margins due to greater BRICS integration of payments. But most commodities are still priced in dollars, and so both the denominator falling and some of these, the marginal commodity demand is in emerging markets. United States and Europe and Japan are not greatly increasing their commodity demands. It's the emerging world that is. And so when kind of the dollars relieved from them a little bit, they tend to have more of an economic boom, which tends to be pretty commodity intensive. So if American gets marginally richer, they generally don't consume a lot more commodities. They're already kind of consuming a lot, whereas the marginal emerging market person, they're consuming a much lower baseline, and so they meaningfully do tend to increase their commodity consumption when they have some sort of when the economy is going well. And if you look at like the dollar denominated GDP of places like Brazil or much of Southeast Asia outside of India, a lot of them have like been sideways in dollar denominated GDP for years. That tends to happen when you get these strong dollar environments. And so they've been kind of flatlining for a while. And if they do get that cycle reverse, you could see meaningful commodity demand out of them. Of course, the other big component to watch is the capex cycle. So the shale growth really kind of destabilized global oil markets, but that's not part of global oil markets. That's now kind of integrated into the supply demand characteristic. We generally see wells depleting faster. A lot of the drilled but uncompleted wells have already been used up. We see kind of just like flatlining U.S. oil. I think that's probably a trend that has some legs to it. OPEC still has spare capacity, but it's not that hard to kind of grow into that. If you do get a pretty significant, if this rotation occurs to any meaningful degree over a 3 to 5 year period, I would expect to be pretty bullish for broad commodities. So I generally am in that view that a lot of those assets together are likely to do fairly well over this next upcoming cycle.
Okay. And could I press you on any speculation about timing there, Lyn? And if you don't like to touch timing questions, no sweat. Neither do I, but I'll hand it to you.
So there's a couple different areas. One is if you look at Latin American equities, so let's say the ILF ETF, and if you do a ratio chart, total returns, ILF versus the S&P 500, it's actually been like it bottomed like a few years ago. And it started to reverse, and then it kind of pulled back in the U.S. favor again, but it hasn't hit a lower low yet, meaning that this rotation's kind of been in place for a few years, where for many years the U.S. was outperforming Latin American equities, and now that's kind of not happening anymore. It's not really going back in the direction yet, but at least it's not continuing. And so I do think that we're probably into that rotation phase now. If you look at the S&P 500 versus broad emerging markets, that still is that's not started to reverse yet, and that's largely because Chinese equities have done so poorly. And
Okay.
some of that's a policy choice on their end. They can kind of end that like whenever they want to. So I think that the timing question will partially come down to, when you look at that broad index, is what is China going to do? When are they going to when are they going to decide to change their policy mix? I think we're already seeing signs of it, but it's still kind of early. I think that the rotation might have already started in Latin American equities. Potentially just ex-China emerging markets in general. And I think that the gold breakout obviously has already been interesting. So I think we're kind of at the early stage of this rotation happening. When you look at the post-dot-com bubble cutting, we had U.S. like economic softness in 2001. Emerging markets were kind of basing relative to the S&P 500 for 2002, 2003, and then they started to really take off until 2007 or so. That kind of ratio is very much in their favor. So I think that this is probably a multi-year story that'll probably take more patience to play out. But at least on some of those markets, I'd say it already has begun. Gold's broken out. Latin American equities are not really hitting lower low when you look at a total return basis. And so I would kind of monitor those trends to see if they continue.
Okay. I appreciate that. I want to pivot a little bit and talk about some concepts from Broken Money, your book, which is right here on the shelf behind me. First of all, congratulations on this, Lyn. Like, the amount of research and work that you put into this book is extraordinary. So hats off to you for that time and energy investment, and the whole team behind it, I'm sure. Maybe the first question that I want to ask, because we just talked about gold a little bit, is I get asked this question all the time from people who don't work in the commodity sector. And they ask me, what's with people's infatuation with gold? Why gold? Why is gold a monetary metal? And, the most common answer that I hear and the most common answer that I give is, 5,000 years of history. Which is kind of a cop-out, to be honest, and kind of a non-answer, because just to say, it's always been that way isn't an explanation of why. What I thought you did extraordinarily well in Broken Money was discuss the evolution of gold as a monetary metal in a very simple evolutionary process. And you discussed many monies that have existed throughout time who, when faced with the stress test or other competitors, just were weaker than the arriving competitor, right? And essentially, gold, silver became monetary metals because it's the same as any other survival of the fittest game, and they outbeat their competitors many times. Could you touch on that? And then I've got some threads I'm going to pull on, I'm sure.
Sure. So in any society, things tend to gravitate toward a common unit of account, which is the most saleable good. Basically, the good that if you were to bring to a market, the highest likelihood that you could sell it for whatever you want. Because otherwise you have a lot of friction in trade. And so generally speaking, some commodities emerge as that which is more liquid, more accepted, and the thing you probably want to store your excess savings in. So most commodities don't really have a monetary premium. They trade based on their utility value, based on their supply and demand, and people don't really store a lot of excess savings in them. They don't just store up barrels of oil, for example. It doesn't have the right properties to do that at scale. And certain commodities start to, in a given technological era, have that feature. So in really early societies, shell jewelry was kind of the thing that, it's the most labor to make it. It's not easy to rapidly increase the supply of, and we can kind of put our excess savings into them. But then over time, basically, anytime you put monetary premium into a commodity, there's a big invitation to dilute it. It's basically saying, look, this is so valuable, we don't know how to make more of it. So if someone does figure out how to make more of it quickly, they get a lot of money. And so over time, as technology improved, we went into the Industrial Revolution and all these other things. We got better at making most types of commodities. We can make all the shell jewelry we want. We can get furs. We can, grow as much tobacco as we want. All these things that were once used as money, it becomes very easy to dilute them. And so people have to always kind of shift toward what is the hardest money to rapidly increase the supply of. And so over thousands of years, gold and silver became the primary answers. That even when, even in our modern technology, we still can't radically increase the supply of gold over any short time period. Only at times where we literally, like, when industrialized societies found new continents, that's the only kind of brief time period where you could kind of temporarily inflate their supply at above average pace. Because gold and silver have kind of like an inbuilt difficulty adjustment, which is that our technology gets better at finding them over time, but we've also mined a lot of the easiest deposits. So the deposits are getting harder, our technology is getting better, but we're not really increasing the supply too quickly. And if you look at gold over the past century, it's ranged between, and this is like World Gold Council data and US Geological Survey data. There's a couple different data sources you can look at, but gold supply is estimated to increase by 1% to 2% per year on average. And it's been a fairly tight band. You have to go back to the gold rush to find when we kind of meaningfully broke above that. And that was in large part because, again, an industrialized culture was coming to a continent that had not been industrialized yet. So they had a lot of low-hanging fruit to pick, kind of in terms of gold mining for at least a period of time. And so basically through the process of iteration, societies came to see that gold and silver are the best ones. And the main reason why silver held its value is because gold's key limitation was divisibility. Even a small gold coin was worth more than most purchases. So silver was kind of the more daily use metal. And so this only became challenged in the telecommunication era because, prior to telecommunications, speed didn't matter. All commodities kind of moved at the same speed. Things like coinage could help speed up, the act of weighing and verifying, a given commodity. But other than things like that, there wasn't really a big speed difference. But in the telecommunication era, we started to send, and that started in like the mid 1800s with the laying of the long distance telegraph cables. We started to do commerce at large distances very quickly. And so we started abstracting and paperizing everything. And we started kind of getting liftoff away from gold. And so it's kind of the first time we pivoted from a stronger commodity to a weaker commodity, kind of the dollar, like this ledger system it's actually less sound. We spent thousands of years always getting more and more sound, from shells to tobacco to silver to gold. And we kind of started reversing because speed was a new variable that mattered. So yeah, it's not an accident that humans settled on gold for so long. It's because it's the commodity with the highest stock to flow ratio. So how much exists compared to how much can be produced in a year. And so it's obviously got very good properties for how much value density you can store in it, how long it lasts when stored. Basically, it's not an accident that all of its properties line up to be good money, and then therefore it's used as good money.
I love that. And so, and you use some amazing examples in your book, like you mentioned shell jewelry, wampum, something that most people are probably familiar if they saw it, little shells with a hole drilled in the center and then often like a leather strand, and the shells are slid onto it. It becomes like a big belt, essentially. It can be worn as a belt in ceremony, but exchanged as value and a store of value. In your book, you described how it was Jack Astor that learned how to industrially produce wampum. And therefore he had his own printing press, more or less, and could show up along the eastern seaboard and trade with the indigenous communities with currency that he was creating. And until people knew that he was just creating his own currency, he's allowed to show up and buy whatever goods he likes with. And same with rye stones on the island of Yap, which I'd never heard of in Micronesia, but they had this rye stones, massive stone circular discs that were a store of value. Similar, the supply is governed by nature's ability to reproduce it, very slow, and an arduous process to create, which governed the supply until David O'Keefe learned how to industrially produce rye stones and shows up on the scene with effectively a printing press in his back pocket. That hasn't occurred with gold and silver yet. So no one's been able to show up on the scene with a secret printing press in their back pocket, and that's protected the utility of gold. However, if we haven't found a technology solution like that, we have run into a technology problem, which is that we now want to transact at a speed, and the demand for speed is in excess of what gold could deliver. That's why we transitioned to fiat. So are we now, therefore, and this is maybe getting a bit esoteric, but at a place where we've proven the problems with the existing currency, but we've yet to find a new one? Like, we're in this weird bridge scenario where we haven't we've proven wampum doesn't work, but we don't have the solution to what's next yet. Would you agree with that?
I think that's kind of the phase we're in. I think we're in the early phases of finding solutions. And so the way I put it in the book is that fast transactions are an easier problem to solve than fast settlements, right? So if you have Morse code and telegraph, you can do fast transactions. Two people can talk across the Atlantic Ocean and agree on a transaction. And then the settlement is the hard and slow part, sending and verifying gold. Even in the modern era, when Germany repatriated its gold, they expected it to take like 7 years, and they were happy that it only took like 4 years, which is it's kind of a comical number, and it costs millions and millions of dollars worth of logistics and security and auditing and all these things. So settlements have been a problem. One of the things I cover in the book is that Bitcoin's interesting because it's kind of the first time where we invented fast settlement, which is to say that as long as the network remains reasonably decentralized, I can send you value, and within 10, 20, 30 minutes, your Bitcoin is confirmed on chain, and I have no way to pull that back. It's kind of final settled unless the majority of miners decide to start reversing transactions and things like that. And so that's kind of the first true possibility for finding that solution. But then, of course, it has to go through this very long process of being tested, right? So then people make thousands of other cryptocurrencies, and they say, well, can these do it better? Can someone find a way to hack it? Or how can it be updated over time to be more efficient? And all these things kind of happen, and it's still a very small market. It's only $1 trillion plus market cap in global fiat money is something like 100 trillion. And so it's still this kind of early phase to see if that's actually going to be the solution. I think it's a very powerful solution, but it obviously takes time for the market to test it and adopt it. And so as long as we're still in this world where Bitcoin is small, fiat is big, we're still kind of in this weird limbo of, fast transactions, slow settlements. And one of the things you see is that both on an individual level and on a national level, they consider speed to be a variable. So a central bank holds treasuries in large part because they can liquidate them in any kind of business hours. They can just say, we want to sell the treasury and buy back our own currency. Whereas if they're holding gold, it's the logistics of saying, hey, we just want to sell, $10 billion worth of gold right now. It's hard to do logistically. And so they do hold it for a portion of their savings, the part they don't really plan to touch anytime soon, whereas they hold other assets that are faster. And for individuals, they start monetizing things like the S&P 500 or oceanfront real estate or lakefront real estate or fine art, right? There's these other monetary things that kind of compete with gold, even if they're not really money in the traditional sense. They're things that they become our primary store of value. They're more efficient. They are powerful. But a lot of people, especially in developed markets, forget that in developing markets, that's not always available. A middle-class person in Egypt can't easily buy the S&P 500, for example, and their local stock market does not have the same long-term store of value properties. And so in those markets, they gravitate toward physical dollars, ironically, or they gravitate toward physical gold. And these are still kind of stores of value in those societies.
Okay. Thank you for that. Now, so a couple of things you made me think of there. When I use Bitcoin from a transaction standpoint, and from a transaction standpoint, I actually love it. So I run a conference in January in Vancouver, and I have about 100 keynote speakers. I fly them in from all over the world, and I compensate everybody for their time. And as a consequence, I actually transact in 4 different currencies because some of my keynote speakers are Canadian. The conference is in Canada, so I pay them in Canadian dollars. I pay my Americans in American dollars, but some want to be paid in physical gold, and those I pay in physical gold. And more recently, a few want to be paid in Bitcoin, which honestly is my favorite because 30 seconds on my cell phone and payment's been sent. It's the most convenient and easy way. And some mutual friends of ours you would know like to be compensated in Bitcoin, and I love it. My accountant hates it because 4 different currencies in one P&L. And then we have barter as well, which I guess would be a 5th currency. Sub speakers want an exchange of value. They want exposure on a a product or service they have, and so there's a barter component to it. So we do run the conference in five currencies, I suppose. So when we're looking for what's next, and a question you brought up continuously in your book was who controls the ledger. As you analyzed commodity money being shells and rhinestones and all this, you analyzed fiat currency. The question you kept on coming back to was who controlled the ledger as the most important question. Maybe I'll start with that. Why is understanding who controls the ledger very important, Lyn?
Right. So when we think of money, at the end of the day, it's kind of a ledger, right? In either the literal sense or the abstract sense. So, you mentioned barter, for example. An example I use in the book is that when I was a young engineer, we would often go out to lunch, like me and my coworkers would go out to lunch, and we kind of take turns driving. And if someone at lunch doesn't have like enough cash on hand, back when people paid with cash more often, they would just say, "Hey, can you just cover this, and I'll pay back tomorrow." Everybody kind of keeps track of this ledger of who's driving enough, who's not driving enough, who's who owes who money. A lot of things are just kind of solved by having this like mental ledger, this kind of informal mental ledger between us. And that's how a lot of hunter-gatherers do it as well. There's basically this kind of like family and kin type of arrangement. As things formalized, we started putting things into literal ledgers. And commodities also serve as kind of a nature-governed ledger. So if we, for example, trade around gold and silver coins with each other, we're using nature as a ledger. We're using the fact that nature has kind of this governing process on how hard is it to mine gold and silver? What do you have to do to get more of it? What are its properties? So we're kind of trusting nature that those properties are going to remain consistent. That sometimes is violated. Like in those other commodities, they were fairly consistent, but then new technology comes along and they can kind of cheat the ledger, at least compared to everyone else's technology. So far, gold and silver has been really resistant to that, which is why they're still monetary commodities. And so either whether trusting nature to run the ledger or trusting humans to run the ledger, we're in this environment where in order to not get our money diluted, we have to have some trust in the ledger that we're using. And in the modern fiat currency era, that's a trust that's commonly violated. So in Egypt, for example, I keep using Egypt because I live part of each year there. They've got over 20% structural money supply growth year over year. And so if you're holding Egyptian pounds, and many people still operate in a cash economy there, especially on the lower end of the income spectrum, it's not a heavily banked society. There's the middle class and up is generally banked. Some of them can earn interest on their bonds, things like that. A lot of the lower class is really just moving around cash, and they're storing cash as their savings. And this unit is getting diluted at 20% per year or more. And so they're kind of trusting a ledger that's getting kind of weaponized against them. And it's not as obvious as taxes. If you earn income and then you're told you have to pay X% back, it's a very visible tax. Whereas if you're earning an income and you're getting 5 or 10% raises per year, but the money supply is growing by 20% per year, you're getting both your wages and your savings invisibly taxed because the ledger is being diluted against you. And then even as gold holders, you have to understand the properties of gold, which is that you're probably going to get diluted by 1.5% per year on average, which is obviously a much better figure than US dollars that get diluted at roughly 7% per year long-term on average, or emerging market currencies that on average get diluted in the double digits per year. And so understanding your expectations around dilution and understanding who controls the levers of those dilution. If the fiat currency, it only takes a small number of decision makers to really dilute your savings and your wages. Whereas something like gold, there's no central authority that can just decide there's going to be 10% more gold this year, right? It's this very decentralized process of miners going around exploring for it, permitting it, building the mine, putting a lot of energy and labor into it, refining the metal. It's a very expensive, time-consuming process, and so it's very hard to rapidly change that unless there's some amazing new technology to get gold off the sea floor or from an asteroid, or whatever could potentially maybe break that cycle. Still not really in the intermediate term to worry about. So it all comes down to what ledger are you trusting for your store of value and your, what you denominate your contracts in. And then even on the international scale, if a Brazilian company and a South Korean company want to do some sort of trade with each other, it's quite possible that the Brazilian company doesn't trust South Korean currency. The South Korean company doesn't trust Brazilian currency, because if you denominate something in the other's currency, they could just print a lot more of it.
Yeah.
And so generally speaking, they go to a third party and they say, well, let's trust the United States currency. That's kind of what a global reserve currency is. It's kind of like the largest, most liquid, most sound, even though it's still being diluted. It's just saying that neither of these companies and their governments can kind of unilaterally shift the contract around. And what they have to rely on is the United States, with its little bit more checks and powers and longer track record of success, at least in the scope of a business contract term, that they kind of trust that ledger. So a lot of these decisions come down to what exactly do you trust to denominate your contracts in, including your wages, and then also to store value in.
And the way you said it there, they have to trust the US dollar, and sort of for lack of a better option, because they may not trust each's individual currencies, but there is this one central currency that, for lack of a better choice, and it does come down to trust. You made me think of when the Spanish Empire was declining and they were still transacting in Spanish, was it lira, the silver coins? But after Mexico fought for their independence and reclaimed the Mexican silver mines that were being used to create most of the Spanish currency, Spain began diluting their currency to a much greater extent. And Mexico began minting coins from the exact same mines that used to mint Spanish currency, but they were able to mint actually at a higher purity and take these coins to market. But even though they brought minerally equivalent or even superior silver coins to market, they were Mexican coins. And nobody at that time wanted Mexican coins. They wanted the diluted Spanish coin because it was the military they trusted, the trade routes they trusted, and all of this. So we're kind of getting into the concept of de-dollarization at this point, which maybe is a good final topic to cover here. What's your take on the conversation around de-dollarization, countries looking for alternatives outside of the US dollar so they don't have to use the US dollar as they have for the last 40 years? What's noise and what's signal in the de-dollarization conversation, Lyn?
Yeah, it's a good set of questions. One is, I think that network effects take a long time to chip away at. Network effects don't really turn on a dime, and because they're so self-reinforcing. And so, for example, part of why everybody needs dollars is because they have dollar-denominated debts, and so your cash flows have to match your liabilities. And so that dollar-denominated debt represents inflexible demand for dollars specifically, unless you're willing to default and have the consequences of defaulting. And then two, even sometimes the currency's better. Like, I mean, Swiss francs have outperformed the dollar. The dollar is one of the best performing currencies of the past century. Swiss franc was even better. But the Swiss franc is just not big and liquid and saleable enough. Same thing for like the Singapore dollar, for example. There are these currencies that are in many ways even more trusted on a kind of a per unit basis, but they're just not big enough markets. And so you can have your case where people should ideally want the more pure Mexican currency and not the diluted Spanish currency, but the Spanish currency, that's what their debts are denominated in. That's a bigger market. It's more liquid. If you bring it up, people are going to recognize that coin. Whereas if they see a coin they don't recognize, they're going to say, I don't know if that purity is higher or not. I don't know that coin. And it's going to be harder for them to get it off their hands, and then there's more friction from the smaller currency. One of the things I highlight here is that like Norway is one of the richest currencies in the world, countries in the world on a per capita basis. I have Norwegian currency in the drawer next to me, and yet there's nothing I could do with it in New Jersey. It'd be very hard to get Norwegian currency off my hands here in New Jersey, because it's not that it's a weak currency. It's just that it's small and foreign. No one knows what to do with it, even if they receive it. And so these network effects take a long time to chip away at. I think the BRICS alliance is kind of the most credible way to chip away at it, which is to say that there's now, the United States is like 4% of global population. It's less than 25% of global GDP and about 15% GDP on a purchasing power parity basis, meaning kind of how much actual real stuff is created or done. Um, and so there is kind of a situation where even the United States dollar is not really big enough to be the global reserve currency by itself anymore. And there's plenty of incentives for countries like China that are now, depending on the metric you look at, roughly the size of the US, bigger in some areas, smaller in other areas, to try to move toward their own currency. And some of their local trading partners also want to move either to their currency or a combined currency, or rely on China's currency or use a couple different currencies. And to your point, using multiple currencies, like you mentioned, you have 4 to 5 different currencies you have to manage as a company. That adds frictions to you. So you need a pretty good reason to want to do that. In your case, it's because you have speakers from a couple different backgrounds that want to get paid in different currencies. So you accommodate that despite the frictions. And all these attempts at de-dollarization kind of have the same frictions, which is that if you're Russia and you're trying to figure out what to sell your oil in, you can sell it to India in rupees, but then you run a structural trade surplus with India, and you have all these rupees, and it's more rupees than you want. And then you're selling to China, and you have the Chinese yuan, and now you're managing multiple currencies,
Mhm.
and then it's okay. What are we going to do with this other country? And it's much easier when there's like one big depth of a capital market. Europe kind of found a similar problem, which is so they unified their currency, but they didn't unify their capital markets. So French bonds are different than German bonds, and Italian equities are different than German equities. And so they have this common unit, but they don't have this common capital market of high liquidity that they can store their euros in and then pull it out without thinking about it, like you can with say U.S. Treasuries or the S&P 500. They don't have that common capital market. And for BRICS, they have a similar problem, which is that you have all these bilateral trade deals. So they are starting to de-dollarize. Russia and China have de-dollarized much of their trade, and then Russia and India, and all these things are forming. But a series of bilateral agreements is just a harder, more friction-filled thing to do than if everyone's kind of using the same ledger, right?
Mhm.
And they only gravitate toward that because now there's a strong incentive to do so. That if you hold too many dollars, you're at risk of getting frozen or confiscated, or sanctioned. And so there's all these incentives to start going around that, and it is slowly happening. So I think the signal is that it is happening. You want to look at a couple of key things. One is how much trade volumes happening outside the dollar, especially in kind of BRICS or Shanghai Cooperation Organization countries. How much non-dollar trades happening? What are the new bilateral trade deals? And then what percentage of global reserves are held in U.S. assets compared to other things, whether it's other currencies for more diversification, or whether it's gold, for example, or in El Salvador's case, even Bitcoin. Some smaller countries can start doing Bitcoin. Kingdom of Bhutan mines Bitcoin with its excess hydro. So around the margins, what are they holding if they're not holding dollar, and what is the dollar share? So I think my expectation is we're entering a more multipolar world. The dollar's share will fall, even if it's still the biggest one individually. So the dollar's kind of percentage in reserves could still be bigger than others for quite a while, but that its absolute percentage is probably going to gradually shrink compared to all these other options that exist now, and especially now that other large economies are incentivized to switch.
So when you say all these other options, I feel like that's maybe an important headline, because the most common question people ask when it comes to de-dollarization is what's next, right? We had Portuguese currency, Spanish currency, Dutch, British pound sterling, American US dollar. What's next? But what might be next is a return to a multipolar currency world, not one unified leader, which might be more of a reversion to the mean in a larger look at history. Would that be the case, that if we probably won't see a successor? Like maybe it's not going to be the Chinese yuan. It's going to be a collection of alternatives. Project Enbridge maybe being one. Some countries still using SWIFT, but maybe a variety of alternatives for countries to transact on a global basis. Yeah, slowly continuing to eat away at American dominance. Yeah.
Yeah, I think we're going to see more regional currencies, which is to say that in Asia, the Chinese yuan could grow in share.
I see.
Whereas in Europe, it's still going to be the euro, and in North America, it's more like the dollar, more regional effects. And then another point I like to make is that the Portuguese currency, the Dutch currency, and the British currency were ultimately gold. Right, so it
Right.
basically gold and silver, precious metals. So really, the global reserve currency at that time was gold and silver, and there's some abstractions of gold and silver that were more liquid and saleable than others, basically whatever the leading naval power was at the time. And at that time, global reserve currency for a long time mainly meant Europe.
Yeah. Right.
And only by the time you got to the British pound did it become rather actually global. And even then, it was not every country, but it was the first one to become truly global. The United States is different because it's actually the unit of account is just untethered to gold, right? It's dollars and treasuries. That's actually the anomaly, historically speaking. So people often say, it was this currency and then this currency and then this currency. Well, no, it mainly was just centuries of gold and silver, and then this kind of multi-decade window of dollars. And what I generally argue is that if you look at the U.S. like after World War II was something like 40% of global GDP. The others manufacturing bases were destroyed. The United States had the strongest industrial base. We had energy. We had the best geography, the strongest military. Just completely dominant. So that was a very centralized era. And over time, we've shrunken from 40% of GDP down to 15 to 25%, depending on how you measure it. The rise of China and India back to their historical kind of large impacts on global GDP. As we enter this more multipolar world in terms of the economy, there's really no currency big enough to be the currency for the whole world, in terms of one country's currency. You generally need either multiple ones, more regional ones, or you need a supranational currency like gold, or one day Bitcoin, perhaps, things that no one country can just unilaterally change or freeze or do things like that. And so the current ones that are big enough and liquid enough are really gold, and then a handful of other large currencies in the world.
The one question I have on that, and then I'll let you go because I know we're at the top of the hour here, is there's so much power in controlling the ledger. And I just have to think that I can't imagine a world where no country, no superpower, no politician isn't fighting for their life to control that ledger. Now, and the reason maybe that's relevant in my mind right now is because if gold was the reserve currency for that long, its supply was governed by nature. That's true. But if we move towards some kind of a decentralized option moving forward, that's going to be on the back of human created technology. And therefore, whoever creates that technology controls the ledger and therefore the power. And I love the idea of a decentralized ledger. But if I'm being honest, it also sounds too utopian in a sense. It sounds great, but I can't imagine a world where that exists because of how much power there is in controlling the ledger. And therefore, we're far more likely to end up in a weaponized, I guess, CBDC scenario. What's your take on that, Lyn?
I think that the check on that is that there's multiple international countries, right? So one country might want to exert its force, but then multiple other countries can say, well, I don't really want to hold too much of that one because I don't want to get rug pulled or frozen. The United States spent trillions of dollars in wars in the Middle East, for example. The cost of enforcing things is very expensive. And then especially as technology changes over time, it gets more asymmetrical. Things like drones. We can't even, the United States, for all their blue water Navy power, the Suez Canal has been effectively shut. The Red Sea has been effectively shut for the better part of a year now. And just both the will and the expense of opening it, let alone if you had to deal with dozens of those types of scenarios around the world. So basically, if you're a country, there's now a strong incentive to diversify your holdings, right? So instead of putting everything in dollars and treasuries, you'll say, well, I trade a lot with China, so I'll put some in China. Because China's the biggest trading partner in the world now for most countries. So it's like, well, if I hold yuan, I can always turn it into Chinese cars and electronics and all that. Then you'll say, well, I want to hold gold because nobody can print gold. And we are seeing a lot of central bank buying of gold. If you're El Salvador, you say, well, we hold some of that stuff too, but we also want to hold Bitcoin. We want to be kind of the Bitcoin hub, kind of arbitrage that option. Right now, Bitcoin's only, something like 1.2 trillion market cap. I haven't checked lately. Not really big enough and liquid enough to be something that, large countries are going to want to hold. The interesting thing about Bitcoin is that even if Satoshi Nakamoto came back today, he couldn't really control the ledger. He designed it in such a way that, especially after the first few years, he can't control it. The power is held in nodes around the world and miners around the world. So nobody can push updates to all those nodes and miners. It's a voluntary opt-in system. And so if you're a country, you have a lot of incentive to own things that get diluted less, or to diversify into things so that no one power can rug pull you. So, countries like the US will still want to project their currency power, but others will be pushing back against that. And it's not really a strong option that the US has to enforce it. And then a point I make in the book and elsewhere is that the US's reserve currency status is a double-edged sword. Having such a, the most widely held currency in the world, and all of this monetary premium on our currency, it's really good if you're the U.S. government. It's really good if you're Wall Street. It's basically all you're in the dollar exporting business, as Luke Roman would put it. But that also hollows out our industrial base. It makes, we have the way we supply dollars to the world is through structural trade deficits for decades. And that starts to eventually outweigh the benefits. So you get more populism and more demands to reshore manufacturing and things like that. And you run into national security issues. Like there's a pandemic, and then you realize we can't even make masks, or we can't make certain medical equipment. We've so outsourced our industrial capabilities, where some of the logic or some of the risk reward starts kind of shifting the other direction. So even the one trying to project the power might want to walk that back. And so, for example, if you look at the current presidential race, both Donald Trump and J.D. Vance have openly discussed, currency revaluations to try to help with the trade relationship, for example. Those start to become more open talking points when the negative effects from deindustrialization start to, kind of equal or outweigh some of this power projection capabilities.
Okay. Look, Lyn, I want to thank you for coming on today. LynAlden.com for more of what you do. And there you can sign up for Lyn's free 6-week newsletter to start. And it's a no-brainer. There's no downside. Every 6 weeks, you get a long form essay from Lyn, and sharing at a certain depth, some portfolio allocations, and then you can take the next step and upgrade if you want more. But it's an absolute no-brainer. It's a free newsletter every 6 weeks, and it's amazing. Also, check out Broken Money on the shelf behind me. You can find it on Amazon or probably at lynalden.com, I imagine. But best-selling book and phenomenally well-researched. I'm going to have to read it a second time. It's one of those, Lyn, by the way, that, I read it and listened to it. I'm probably going to have to read it again, or at least cherry pick my chapters and go back to, because there's so much in there. But thank you for writing that. And thank you for coming on the show today.
I appreciate that. Thank you for having me.